Uh, UPSC Indian Economy Current Affairs series. This is the 8th lecture as a part of Current Affairs Indian Economy. Uh, Posting almost every week without missing. So from June especially, almost all the Indian economy current affairs have been posted. So please do watch them, and also if in case you have not yet subscribed to our channel, kindly subscribe so that you will get free notifications when it comes to current affairs class. Let's look at this. Current affairs Indian economy: rise in India's foreign exchange reserve. Forex reserves. The moment you hear the word foreign exchange reserves, you need to understand one thing, that any foreign currency that is earned by India or received by India will be actually managed by Reserve Bank of India. Say for the first sentence you see here, foreign reserves are external assets in the form of gold, in the form of special drawing rights, slowly, and in the form of foreign currency assets such as capital which came into India, FDI, and external commercial borrowings. Let's understand this carefully. So this clearly tells us one thing, that India's foreign exchange reserves includes what? India's foreign exchange reserves includes what? It includes gold that we received. It includes SDR. Let me explain this. Special drawing right is a claim on currencies in IMF. There is an organization called International Monetary Fund. International Monetary Fund is basically the organization which will provide foreign currency to all the member nations. If in case you have got any problems when it comes to balance of trade issues, balance of payments issues, like you require a lot of foreign exchange to purchase imports, and you need foreign currency, the reservoir of foreign currency for any balance of payment crisis or current account crisis, you can go to International Monetary Fund. So International Monetary Fund member will contribute something, and every member will have a quota to receive foreign exchange. Every member suppose India will contribute rupees in IMF, and in return IMF will give any foreign currency that India wants. It can borrow money or it can take against the reserves that it has. Everybody clear? So how much of special drawing right is basically how much of foreign currency I can borrow. It's a claim on the currencies that I have. Every country has a claim on the currency. It's not a currency of IMF. Try to understand this. Some books have printed wrongly. It is not currency of IMF. It is a claim on currencies. So as a member of the IMF, what do? I will keep some reserves. I will keep mine in rupee. Okay, that is called holding. I will have some quota to receive money. Okay, so the special drawing rights are basically a basket of 5 currencies like dollar, etc. So the special drawing rights that we have is also a part of Indian foreign currency, plus foreign currency assets, in the sense anything that came into Indian stock exchange. Anything that came into Indian stock exchange is also called foreign portfolio investment. That means in India we have a stock exchange, and foreigners might invest in Indian companies. That means they might purchase shares of Indian companies, securities of Indian company. They will definitely bring foreign currency. That is foreign portfolio investment, capital inflows. Yes. Next one we have something foreign direct investment. Foreign direct investment means foreigner directly come and invest in India, and that too in any Indian company. If you invest more than 10%, it becomes foreign direct investment. Like you see, what is the difference between foreign portfolio investment and foreign direct investment? Foreign portfolio investment is like foreign company will come to India, purchase Indian company shares which are not more than 10% of Indian company capital. I mean, when you go for FPI, maximum up to 10% you can buy Indian company shares. You will not have any control over the management of company. But when it comes to FDI, two ways. Where foreign company directly come to India and invest in India, if it invests in Indian company, it will invest more than 10%. That is foreign direct investment. Generally, foreign direct investment is a long-term investment, whereas foreign portfolio investment is a short-term investment. So whatever money that we received in the form of foreign portfolio investment, which means foreign company has come to India and invested in Indian company shares, which is not more than 10% of Indian company share capital. And foreign direct investment is basically the investment which is invested by foreign company directly in India. I mean, they established here. Otherwise, they must have invested in Indian company, which is actually more than 10% of Indian company share capital. So foreign direct investor is investment basic objective is like we don't have any risk. We don't have to repay. It will not go simply. It is a long run. So always we need to aim at more of foreign direct investment. External, ECBs. In simple, so we have FDI, we have ECBs. ECBs. When I say ECBs, external Indian companies borrowing money from foreign governments or foreign banks. When Indian company or Indian corporates, Indian individuals borrow money, Indian governments, Indian corporates borrow money from foreign banks, that is external commercial borrowings. So money. I mean, Indian foreign reserves, Indian foreign exchange reserves can be in the form of gold. When we import money, sometimes we receive gold also. Otherwise, we convert the currencies into gold. Suppose I want to sell something. If that other country doesn't have other country currency, I don't want. So now I can ask for a gold, right? That is the thing. So gold that is received, SDR that is received from IMF, foreign currency, right? SDR is a special drawing, right, which is a claim on foreign currencies in IMF as a member of the country. It's a basket of five currencies, right? Foreign portfolio investment that came into Indian stock exchange as a capital flow, plus foreign direct investment where foreign company has come directly and invested in India, or it has invested in Indian company which is more than 10%, because in FDI their main objective is control and management of the company. And loans that are taken by Indian government, state or central government, or Indian corporates from foreign banks will be ECBs, external commercial borrowings. All these things will be together, we call them as foreign exchange reserves. Foreign exchange reserve, these reserves, according to the latest current affairs, I'm telling you, because the IMF again is a big concept about SDR, etc. I will cover it separately. As of now, you understand this is all foreign exchange, which is actually controlled by whom? Reserve Bank of India. Reserve Bank of India is the central bank of India. Okay, look at this next one. It says Indian IMF says official foreign exchange reserve held in support of range of objectives like supporting and maintaining confidence in policies for monetary and exchange rate management system. What happens is rupee value keeps fluctuating. Rupee value keeps fluctuating when say rupee value is depreciating. The devaluation or depreciation of rupee or decrease in the value of rupee happens when there's a heavy demand for foreign currencies. So whenever local currency value is actually decreasing, you need a lot of foreign currency. In such case, IMF is going to help you in this case. Okay, that is one thing. Next one, it will also limit external vulnerability maintaining foreign. So that means you need to have foreign currency liquidity. Ready cash availability of foreign currencies are very important, because you end up purchasing so many things from foreign countries. So you need to have that always. Okay, now the latest issue is this. Actually, the first 3 points are actually general points which I gave you, but the latest current affairs is I want to tell you foreign exchange reserves in India increased. So when we talk about foreign currency reserves increased in India, we are not only talking about foreign direct investment, we are also talking about foreign portfolio investment which comes into for Indian stock exchanges or any of these things. Recently, you must have heard Facebook has invested in Reliance Jio. So almost more than 40,000 crores money has come. Like recently, Reliance has mobilized more than 90,000. Reliance company itself has mobilized more than 90,000 crores from abroad by selling its shares to foreigners, right? Like this. See there, India's foreign exchange reserves are rising. So for prelims examination point of view, you must remember whether foreign exchange reserves in India are increasing or decreasing. Increasing, 500 billion mark almost dollars. See there, it was an increase of almost 12.4 billion. Fifth point, if you could see. Yeah, fifth point, if you could see, this is a 493, almost close to so and so. Okay, $500 billion. The level of foreign exchange reserves has steadily increased by 8,400. So true or false question points, you will get these kind of points, 4, 5, 6 points. Okay, then the major reason, this is also very, what is the reason why recently, they can ask you why recently foreign exchange reserves have been increased. So see, there could be an FDR, there could be an SDR, there could be an FPI, there could be an FDI, there could be ECB, there could be gold that we have received from other countries when we sold goods. That's a different story. But out of these things, which is actually a major factor which has actually contributed for us to have more foreign exchange reserves. Alright, see that the major reason for rise in foreign exchange reserves is the rise in investment in which for portfolio investors and foreign direct. So there are two things which are actually contributing major chunk of foreign exchange reserves. That means most of the foreigners have recently started purchasing shares in Indian companies. Obviously, they have to come to stock exchange and purchase the shares. That is portfolio investment. Another thing is foreign direct investments. Well, simple. Because of COVID-19, China is facing problem. US China has a lot of trade wars going on. Obviously, US companies which are there in China, or UK companies which are there in China. Not only US, UK, most of the companies which are there in China will definitely find another labor force market, that is India. Because after China in the world, great amount of labor you will find, that too English speaking labor you will find in India. So therefore, there's every possibility foreign direct investment would definitely mushroom and increase in India because of this COVID. So COVID-19 has actually given us an opportunity when it comes to industry. So it is all up to government to take this opportunity and grab this opportunity, change policies in favor of foreign companies and take them into our basket immediately before China wakes up and does something to stop them. Okay, that is one thing. So major reason is FPI, FDI. FPI is a short-term investment, and which is normally coming through stock exchange. FDI is basically a long-term investment where they directly come and invest. Otherwise, they will invest in Indian company which is more than 10%. All right. And this is the reason you see. Eighth point is foreign investors have acquired stakes in Indian companies. Example, Reliance company from Facebook. Then on the other hand, the fall in crude. One more important thing: whenever foreign exchange reserves are received in India, generally we have lot of payments to make. Right? That is best example. We buy lot of gold from other countries, we buy lot of oil from other countries, gas from other countries, technology from other countries. These days those payments have been decreased, especially oil consumption, everything decrease. So that is also one reason that we are able to save little amount of foreign currency exchange. $500 billion is a huge amount, and it's really, India is now almost in self-sufficiency. If it is used properly, India will definitely cross other countries in terms of growth rate. But policies also require, many other things also have to support. Okay, that is one thing. The rising foreign exchange give a lot of comfort to government and Reserve Bank of India managing zones. Okay, overall economic growth is set to contract by, so even internal financial issues at a time when economic growth is set to contract, means decrease by 1.5% 2021. So this is going to, our growth rate is expected to fall rapidly in this point of time, or at this point of time, at this juncture. There's every possibility this FDI, FPI inflows which are actually coming from other countries, inflows into our country in the form of foreign exchange, is going to really positively contribute for the growth of Indian economy, no doubt about it. All right. Yes, that is one thing. So quickly, this is a rapid fire kind of current affairs. You are supposed to understand very quickly, since it is 10 to 15 minutes only. Focus, learn something and get 1 mark, please. That is what I advise in this regard. Okay, subscribe the channel please without fail, so that every time when you get these, you will know updates. Next one, role of RBI in this case. Reserve Bank of India is a central bank of India. So custodian of foreign exchange, whatever foreign exchange reserves that we receive through different forms will be under the strict control of Reserve Bank of India. Understood? See there, because whenever currency rates increase or decrease, Reserve Bank of India will make sure that there will be something. So let us look at some points here. Reserve Bank of India is a custodian and manager of foreign exchange reserves. RBI allocates dollars for specific purposes, uses in that way. And for example, Reserve Bank of India has given very clearly under LRS, Liberalized Remittance Scheme, individuals from other countries can send in a year $250,000. How much of money a person working in abroad, or working or doing a business in abroad, can send in a year? How much? $250,000. That is RBI fixed limit. RBI uses its foreign movement of rupee. Simply speaking, whenever rupee value decreases, we will try to use this foreign exchange in such a way so that rupee value will not be affected very badly. And RBI Act of 1934 provides overarching legal framework of deployment of reserves in different foreign currency assets and gold within broad parameters of currencies, instruments, etc. That means Reserve Bank of India will provide legal framework of utilization of foreign exchange in different areas. Then look at this, as much as 64% of foreign currency reserves is held in securities like treasury bills of foreign countries. There is maximum amount of foreign exchange, we kept it in the form of foreign government treasury bills. See, it's like I have some money. How will I save money? I will save in the form of savings account. I might purchase a property. I might have a fixed deposit, etc., right? I might do anything in this way. Similarly, Government of India has received foreign exchange. You can't keep it in the Almora and Reserve Bank of India or anywhere. You can't just keep it idle, right? You have to use it. So majority of foreign exchange reserves, that is 64% of the foreign currency reserves, are kept in the form of treasury bills. Treasury bills are the bills which are issued by government. In India also we have this. So we kept this foreign exchange in the form of foreign treasury bills. We will get some interest rate. It's an investment. Whenever we want, we can sell them in the market and gain money. Understood? Everybody, mainly US. So Indian foreign currency reserves that we received, 64% of the foreign exchange currencies are kept in the form of foreign treasury bills. In that 28% is deposited in foreign central banks, and we deposit it in foreign central banks so that we can borrow money whenever we want and we can withdraw it, we can earn some interest rate, because we need foreign exchange, because India is still not self-dependent country. India needs a lot of commodities to be bought, a lot of technology to be bought, a lot of raw material to be bought. So therefore India requires a lot of foreign currency. You need to save it. That is one thing. So overall, it is giving you data, RBI data. 64% is held in the form of securities. Remaining 28% is held in the form of foreign central banks. 7.4% is held in the form of commercial banks abroad, like Citibank, Standard Chartered, some HSBC banks, etc., etc. So majority of Indian foreign currency reserves are kept in the form of foreign treasury bills. Treasury bills are issued by foreign governments, so we will definitely earn very very good interest rate. Okay, that is one thing. So we don't want to we are not, Reserve Bank of India is not actually keeping this idle. That is the point. Okay, next, border. Next, one more very important current affairs concept you have: border adjustment tax. This is in the news recently. That is today's newspaper. That is 11th of June. Okay, see there, it is the duty. Border means, you can understand, it is the duty, means tax. Slowly understand, it is the duty, that is a tax, that is proposed to be imposed on imported goods. Generally, when the goods are imported from other country, we will impose a tax called customs tax. Customs tax is the tax that is imposed on imported products. Nowadays, highest possible customs tax on any product which is coming from outside is actually 10%. Is actually how much? 10%. Everybody clear? In addition to that customs, suppose I'm imposing a customs duty of, let's say, some 8% on textiles. In addition to this, I wanted to impose something called border adjustment tax. Why? What? Let's see. Very important. It is a duty that is proposed to be imposed, decided to be imposed on the imported goods, in addition, besides customs duty. Understood? So border adjustment duty is a fiscal measure, means tax measure, that imposes charge on goods and services in accordance with the destination principle of taxation. Where is it coming from? Sometimes what happens, some countries will try to sell goods in India just to dump in India, and they slash the prices so drastically, so the domestic industries will be affected very badly. If a bicycle in India is costing, let's say, 20,000, and a Chinese bicycle might be costing, let's say, 10,000, 50% variation, definitely Indian domestic market will be killed. So how do you make such people? You can't say no because you're a member of WTO, but you can definitely make foreign products little more costly, so to protect domestic industry. There are two ways. This is not like a tariff. The World Trade Organization also recently has allowed, under certain circumstances, if in case countries developing, if you think that other countries are just like the dumping products because they give lot of subsidies there, a lot of concessions there, and because of which their products become very cheap when it comes to India. So at the border, if you don't make them costly, then definitely domestic industries will be affected. So certain extent WTO also has allowed. So this is one proposal. Even Niti Aayog also recently has proposed that it's better to impose a border adjustment in the sense, to what extent their products are going to impact our products. If in case they suppose our product in the market is already 20,000, their product is going to be 10,000, so you can impose at least 7 to 8,000 border adjustment tax, so that their bicycle also will become 20,000. And it's a kind of counter-attack. Understood? Under this principle, government taxes products based on location of their sale. Where are they selling to the final consumer, rather than the location of their product. We won't say you're coming from China, you're supposed to pay. Is very important. We don't say you're coming from China, you have to pay this. You don't say you're coming from Malaysia, you don't have to pay. Where are you going to sell this? Understood? Next, therefore, to adjust the tax at the border, country taxes imported products, okay, and domestically produced products sold on its market on the same basis. That means how much of tax actually domestic products are paying, and the same burden, because that product is not born here, the product is born somewhere and coming here, and in that locality how much is the Indian product is paying, the same, to the extent of that whatever tax that our products are already paying, to the extent of that the same tax is going to be imposed on the product that is crossing our borders. Understood? That is the thing, right? Next, generally BAT seeks to promote equal conditions of competition. Basically we don't want to make somebody's product very cheap. If somebody's product is very cheap in India, Indian products are going to be affected, so we wanted to actually have a fair competition. That is one thing. World Trade Organization also allows to certain extent. That is what. So this is border tax which is in the news. So what are the main conditions? Conditions are very simple. It should be a tax must be applied equally to imports like domestic products. What kind of a burden have you imposed on domestic product, since foreign products have not paid this tax which is being paid by domestic product? To the extent of that you can impose a tax on foreign products which are coming into India. Understood? Tax must be borne by product, not direct. Product in the sense the product which is coming, not directly. A permitted border tax adjustment must not subsidize, in the sense again just because there is a tax, again there should not be subsidies on this. Our intention is to ensure that the product which is coming from abroad might affect domestic trade, and domestic traders might be affected. So domestic traders are already paying certain taxes, they must also be imposed on these products which are coming from abroad, so that there will be an adjustment, so that there will be a fair competition. We wanted actually we wanted to have a fair competition in this regard. That is one thing. Next, recently Niti Aayog member also favored this, and this because of COVID-19 and because of trade war that is going on. This is a lot of other countries will try to dump their products in different countries. So this is better, because you see, you need to stop imported products in such a way so that domestic trade is not affected. So for that reason, this will be definitely a clear-cut reason. So let's see, now it is proposed, it's going to be implemented or not, we have to see. Now we have to see also other countries' reaction, we have to see also the World Trade Organization reaction, etc., etc. That is the today's Indian economic current affairs, as I think that it would be useful for you for preparing for prelims as well as for mains. Do subscribe the channel. Anything you want, any material related to this one, please do WhatsApp on 9513333 267. Have a good day.